All right, let's get to China here because while that new front in the trade war was open with Mexico, the ongoing spat with China continues and Chinese manufacturers are feeling the pinch. China released PMI data overnight that shows factory production slumped in May to 49.4, down from 50.1 in April. Joining us now, a Gradient Investments portfolio manager, Jeremy Bryan, to talk about the effect of that, which signals contraction in China, in addition to the effect of these Mexico tariffs. Jeremy, how do you trade all of this while it's having this depressive effect on the market and while the president is now coming out with new tariffs?
Yeah, certainly. Today's events kind of exacerbated the trend we were already on, which is the market doesn't really know what to do right now, so it's selling off. In the regard of how you play it and how you take action on it, it is going to be choppy for a while. I think, we're going to probably be choppy here into the summer until we start to see companies report earnings, I think, frankly, and then we'll get the ramifications of those tariffs into the numbers. And so I think we're going to be trading based upon whatever's happening in the sentiment of discussions. Now Mexico added to the China threat before. I think we're just going to chop up and down here for a while. When it looks good, the markets will go up. When it looks bad, it'll go down until we get some resolution or some final resolution from either of the deals, or we start to see companies so we can estimate the earnings impact to the of these two.
Jeremy, we know the Chinese are taking a bit of a hit. We saw the PMI number, but what about here in the United States, the recent consumer spending number? What do you make of that? Is this going to show up negatively in the next earnings season when we go there in July?
I don't know if it's going to impact the consumer as of yet. That's one that we're still pretty positive on the U.S. consumer overall. But there's only so many hits they can take, right? At the end of the day, they have to be able to spend money, and that's been our thesis the whole time. And if this feels like more and more of a tax on their spending profiles, then that's going to be a problem. But I think overall right now, we're seeing oil prices come down, so gas prices could start to come down a little bit. That acts as a little bit of an easing burden to the U.S. consumer. And still, everyone has jobs, and pretty much everyone is still getting wage growth. So that tends to still be pretty healthy. So if we're leaning in one particular sector, we're still leaning on the U.S. consumer as the source of strength.
Hey, Jeremy Pross here. Just wondering, going back to China, how does a slowdown over there kind of affect these large U.S. multinational companies? Are we going to see that in quarters to come, or are we sort of insulated from even a Chinese slowdown?
Not insulated. I don't believe we're completely insulated. There's certain companies that certainly feel much less of the impact. U.S. consumer-centric companies that do most of their business here. But even then, they're importing goods from there too, in a lot of cases. So you really kind of have to pick and choose your battles a little bit. I don't think anyone gets out fully scot-free and clean because, again, this tariffs act as a tax at the end of the day to the consumer, and the consumer can only take so much of that. So There's companies that will act better, like a utilities type of sector. That's why we're seeing those bid up pretty aggressively here recently. Those won't feel as much of the impact, but I think generally just the overall economy, it will be a little bit weaker if this trade talk and trade discussions continue to deteriorate.
Hey, Jeremy, I got to ask you about one of your picks because you say you got to pick your spots, right? And you gave us some stock picks. One leaps out at me, and that's Broadcom, because this is a semiconductor company, has a big exposure in China, is reliant on Chinese growth, and not only Chinese growth, but stuff being built in China to then be shipped back here to the United States. So why is that one that you're looking at?
Yeah, that's simply, it's a little bit different story, and you're absolutely right. That is one that will be affected by that. But at the end of the day, it's come down over 20% from its recent highs. It's trading very cheaply. It has a near 4% dividend yield, and it also has some specific catalysts in the fact that they did the CA merger not that long ago. And they still have some integration capabilities and really good cash flow generation from that to not only continue to pay that dividend and grow that dividend, but also potentially buy more companies. Now, will they be completely susceptible to the headwinds? And no, they won't be. And there may be further damage ahead, but we think we've seen a lot of that damage already, and we'd be buyers here.
All right. Jeremy, good to talk to you. Gradient Investment Portfolio Manager Jeremy Bryan, thank you.
Thanks for having me.